Various forms of pure arbitrage and statistical arbitrage are the basis for almost all quant trading strategies. When I traded as part of a bank's proprietary group, our strategies were based on arbitraging volatility levels between different currencies and interest rate pairs. We had definite opinions about the level and term structure of volatility in each market, but were completely agnostic about the direction of exchange rates and interest rates. In this section, we'll take a look at the difference between an exchange arbitrage and a statistical arbitrage. We'll also look at some of the challenges traders face in managing stat arb risk. We will cover each of the steps required to execute exchange or statistical arbitrage. We will then look at how to structure an index arbitrage and identify the infrastructure this strategy needs. Last, we will take a critical look at the opportunities and challenges that are an integral part of stat arb strategies. Exchange arbitrage is a form of riskless or pure arbitrage, in which the same asset trades on two exchanges with the asking price on one exchange overlapping with the bid price on another exchange. Normally, the bid price is lower than the ask price. In the example you see here, the asking price on NASDAQ is 100 and the bid on NYSE is 110 cents, or an arb profit of 10 cents per share. The opportunity to make this type of riskless profit has become scarcer as the links between exchanges and alternative trading networks get faster, which reduces the time window in which arbitrage opportunities like these are available. Also, the increase in high-frequency trading firms that specialize in low-latency strategies or very fast order execution strategies has reduced the profits available from this type of arbitrage. In carry arbitrage, the acquisition and delivery of an asset are agreed at the same time, but the final delivery of the asset happens at a later date. Carry is the cost of holding and storing an asset, net of any income that the asset pays you. Unlike bonds and stocks, gold only pays a yield if it is leased out, and the rate for a one-year lease on gold is only about 10 basis points right now. The difference between the spot price and the future delivery price is the compensation that the carry trader receives to offset their costs, which are funding, storage, and insurance. In the example shown, the total carry is $30, or about 2% of the asset's price. This would be less by 10 basis points if you're leasing the gold out. Stat arb is the most common type of risk arb strategy, and mean reversion is a more formal way of saying buy low, sell high. In this example, you want to trade a stock whose average price has been 100. The issuer is a mature company with limited growth opportunities, and you assume the share price will be more or less stable, or more formally, you can model it as a stationary process. This is an unusual assumption, as most stocks are assumed to have an upward price drift due to either profit growth or retaining earnings. The variation of the stock has been 5% over the previous 100 days, so you expect it to vary by the same amount in the future. You create trading rules so that when the stock increases to 5% above its mean, you sell or short it. And when it falls to 5% below its mean, you buy it. Seems pretty easy, doesn't it? Using these rules, you could earn a total profit of 20 based on the buy and sell points marked on the graph. So far, so good, but what happens if volatility is greater than expected? What happens if you short at 105 and then the price goes to 110? Do you sell more stock at 110, or do you lock in your loss by covering the short at 110? Similar problem if you buy the stock for 95 and then the price drops to 90, giving you a 5% loss. Do you buy more at 90, or do you lock in your loss by selling at 90? This is the unavoidable challenge of stat arb strategies. If you set your buy and sell levels too close to the current market, you'll likely make a transaction, but you're going to have a low level of confidence that it will end up being profitable. If you set your buy and sell levels too far from the current price, you're less likely to take a loss, but it's also less likely that the market is going to reach those levels, so you may never make a trade. Designing a profitable strategy means finding the balance between these extremes and also setting stop-loss orders to preserve your trading capital. Another common ARB strategy is pairs trading, where you identify two stocks with similar characteristics and go long one and short the other. For this example, we assume the stocks are trading at the same price and you were able to finance your purchase of stock A with the proceeds from shorting stock B. In real life, you would have to borrow stock B and you'd have to post part of the proceeds as collateral, but we're just going to assume you're able to finance the purchase completely with stock B. The main benefit of this strategy is that since A and B trade in the same market, belong to the same sector of the same industry, you are hedging the industry and sector risk, so any return that you get will be based only on the strength of the choice you make of which stocks to pair. Your decision about which stock to buy and which stock to sell could be based on either a fundamental valuation analysis or on relative historical returns or correlations or some combination of all three. You might determine that the fundamental value of A is $10 more than B, despite them having the same market price. Or you might have observed that B has outperformed A by 10% historically, and going forward you expect the price of A to catch up to B because you expect their returns to be the same in the long term. So you buy A for 100 and you sell B for the same price. You are now long the spread between A and B. Almost immediately, A's share price increases to 110, while B stays at 100. You sell A and buy B back for a quick $10 profit, and then wait for A and B to be mispriced again, which happens when A and B both fall to 95. And you get long the spread again by buying A and shorting B. This time, A's price drifts and ends up back at 95. Meanwhile, B has rallied to 105, causing you to lose $10 on your short. If you panic and issue a stop-loss order to sell A and buy back B, you will lock in a loss of $10. If instead you decide to write out the trade, you will see your loss increase to $15 when A stays at 95 and B rallies to 110. It would be hard not to cover the trade now as you've lost 15% of your capital and you will get pressure from your funders. If you're able to talk them into letting you keep the trade on, your 15 loss eventually transforms into an unrealized $7 profit when A rallies to 107 and B falls to 100. By the end of the period, stock A is trading at 83 and stock B at 103, and you have an unrealized loss of $20 on the trade and an overall loss of $10 for the year. Your funders are not happy and you are wishing you issued that stop loss order, or even better, had taken that unrealized profit of $7 and ended the year up 17. Correlations between stock pairs are notoriously unstable and can move from positive to negative and then back again, depending on what time period you're looking at. This makes pair trading a fairly risky proposition, even though it's considered fully hedged except for the company or spread risk. Other trades, such as pairs of bonds with different maturities and commodities paired with their byproducts, have more stable correlations and are potentially better candidates for pairs trading, which is essentially just trading a spread between the price of two related assets.